Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap with my good friend and great market expert, Lance Roberts. How you doing, Lance?
I'm doing fine. You're throwing too much shade my way today, though.
No. Well, I'm here at the New Orleans conference where everybody gets these really generous introductions when you get brought up on the stage. So I just thought I'd give you a little bit of the same. Look, hell of a week. So look, I'll hand it to you. I'll maybe set the stage with my theme for it, and you add whatever yours is. But for me, it's another whiplash week, right? The other day we had after the CPI numbers came out, the S&P had its third biggest intraday swing in history. It went down to about 3,500, ended up getting up to about a high of 3,680, almost 3,700 before closing. Just crazy times. What is all this volatility signaling?
Well, it's interesting. So a couple of things. Well, let me back up for a second. It was interesting in 2021. I wrote several articles talking about the fact that low periods of volatility beget high periods of volatility. And, in 2021, there was no volatility. The biggest drawdown we had all year was 5%. Volatility index remained very low. This year, we're getting a lot more wild swings. We're getting a lot of these, 1% days, 2% days. We're seeing a lot of those, both up and down. And, that's certainly weighing on investors, mentally. But one thing that was interesting about Thursday, in particular, after CPI came out, the volatility index told you that there was going to be a reversal, right after the morning, because even though the market was selling off and we were down 2% at the open, the volatility index was actually declining. And then right after that, the markets kind of took off and had a pretty strong run for the day. So the interesting thing is that, while we talk about really we kind of talk about volatility in two different measures, right? We talk about the volatility in terms of intraday price swings that we're seeing. But if you actually look at the volatility index, it's actually been very muted this year. It's not what you would expect. You would expect with the market down 20, 25%, that volatility would be running, 50, 60, on the index. And, we're below 30. And that's not really what you would expect to see if this was really a bear market. And again, it's interesting, we talked about this before, is that this is acting a lot more like a correction than a bear market. And there's some markers that are normally consistent with a bear market that we're not seeing currently, right? Now, normally in a bear market, a real bear market, so you go back to 1974 and 2000 and 2008, we were in a recession. That was clear. Unemployment was surging. You had 10-year Treasury rates were falling, 2-year Treasury rates were falling. The Fed was cutting interest rates, not hiking interest rates. So it's interesting that, here we're down 23, 24% for the year, but the market's not really behaving like it's a recession. And importantly, just from a technical basis, we talked about this before, we're sitting right on that 200-week moving average right now, which is the technical bullish trend line going back to 2009. So since the financial crisis, that 200-week moving average has acted pretty much as the buffer for the market. We've come down, we've tested it several times, we continue to hold it, and then the market continues to rally. So, it's interesting. We're sitting right on that very critical support line. So if we're going to have a bear market, this is the make or break point for that. So if we begin to break this 200-week moving average, confirm that break, we're going to be looking at, a 30 or 40% overall decline in the market before we're through. But again, to see that 30 or 40% decline, and I'm going through a lot of this detail in this weekend's newsletter. So if you go to realinvestmentadvice.com, there's a link on the front page to subscribe to the newsletter. I'll email it out tomorrow to everybody. But I'm going through this whole idea of what actually is a bear market, what's missing, and what is likely yet to happen. And again, I think that we've got a lot more risk as we move into 2023 because of all the backloaded effects, these lag effects of all these rate hikes that the Fed has done already.
All right, great. Look, a lot in there. And one I should mention that we had that biggest intraday swing and third biggest intraday swing in history yesterday. Today in the day, we're talking Friday. Market's not quite closed yet, but the S&P is down almost down 2.25% today. So we're giving up a fair amount of what that swing brought yesterday. And if we close around here, we'll be pretty much closing at or just about at the lows for the year. Right.
Yeah.
So the momentum still seems to be down even despite this volatility here. Speaking of which, when you talked about volatility, the volatility index remaining muted, you're referring to the VIX, right?
Right. Yeah.
Okay. So I'm just curious, looked like you had a comment when I mentioned that we may be closing kind of at the lows for the year. Is that a data signal, that in terms of what you're looking at right now that has any importance?
Yeah. Well, and again, kind of, the market is still trying to price in what, is going to be earnings. And, so today we started kicking off earnings. We have the major banks reporting. We've got more next week. By October the 28th, we're going to have 70% of the S&P 500 will have reported. So a big chunk of what the market's trying to figure out right now is what those earnings are actually going to look like. So trying to get valuations in line with where we go. So yeah, closing at near these lows is very important, but it's also important that next week these lows continue to hold. Again, if we take out these lows, then we've got another leg lower here. But right now where we're sitting is basically just below where we are right now are the peaks of the market back in 2020. When we came off those March lows, we rallied into June. And that strong rally into June, we formed kind of a double top there before the market then took off again. So we're now sitting right on top of those previous tops. So there's some support right where we are right now, but we're getting in pretty dangerous territory that if these markets don't start to firm up here, then we run the risk of sliding a bit lower here.
Okay, so really interesting. So there are a few things we've been waiting to find out. And it sounds like you're saying, we're going to know pretty soon the answers to these questions. One of those questions was, what's happening with inflation? We just found out that answer yesterday, and we'll talk about the specific CPI number in just a second. But we've also talked an awful lot about margin compression and the earnings recession potentially that we're heading into, and the fact that the analysts will be forced to bring their earnings forecasts for 2023 down, finally taking into consideration the deterioration in the economic situation that you and I believe is happening from all the other data that we're looking at. So we should know the answer to that question much better 2 weeks from now, right? When 70% of the companies have reported and they've had to update their forward guidance. So a lot could hinge on what we hear over the next 2 weeks. So it feels like, from an investor standpoint, this is a time to be paying a lot of attention because we're finally going to get some important and longstanding questions, if not fully answered, at least a lot more clarity on them.
Oh, that's absolutely right. And again, this is, what, we've already seen a few companies kind of pre-announcing earnings. We're going to see a lot of that. And then the issue is not going to be what the companies report. It's going to be what they say about their guidance over the next quarter, 2 quarters into next year, what they're seeing, because again, the big risk here is to corporate profit margins, and those are still very high. Those corporate profit margins are still very elevated, and those are going to come down because of higher prices again, get passed on, et cetera. So again, it's what's going to really drive this earnings season and whether or not we get some traction in the market or not. It's going to be really come down to what companies say, not what they report.
Okay. And I'll take the short answer on this because I think we'll get more deeply into it in a bit. But if earnings come in the tenor that we think they're going to, meaning, last time we talked, a lot of data points suggesting that the economy kind of started falling off a cliff in September, which means that despite back to school and whatnot, earnings, that's only for certain industries anyways, but, earnings are probably not going to be great this time around. And then companies are really going to have to update their 23 outlook. If they come in the way you and I are thinking, then things really could have some potential for more downward movement from here, right?
Yeah, because again, if earnings come in a lot weaker than expected, then market's going to have to reprice for those lower earnings. And it's interesting. I'm actually writing. So going back to a shameless plug for the newsletter this weekend. I'm actually writing about this because there's a big issue with what kind of goes on in the media right now. You're hearing a lot of people saying, "Well, stocks are cheap now based on forward earnings," and that's a big myth. And it's a myth from this standpoint. It's suggesting that let's just pick a number, right? The market's at 3,600. When they say that forward earnings are cheap, they're saying that if the price of the market doesn't move and earnings are X in 2023, then you've got 17 times earnings, whatever. So the market's cheap. So this all assumes that earnings aren't going to go up or down from here, and that prices aren't going to go up or down from here. But that's not the way it works. And what's going to happen is over the course of the next few weeks, let's say and I run this table in the newsletter. But if you assume the price stays stagnant and earnings fall and start to adjust lower for slower economic growth, et cetera, valuations go up. They don't go down because earnings are coming down, right? And so if earnings are coming down, the price has to come down. And if the price doesn't come down faster than earnings, valuations go up. So this whole idea that forward PE are cheap, it's all based upon this relative idea that one or both parts of the equation aren't moving, and that's not going to happen. The real risk is that we go into next year, earnings right now. So using S&P earnings, they were at $243 a share in January. They're now down to $209 a share. Then they had actually increased those earnings. By the way, that S&P had actually ratcheted up earnings going into June. So just since June, earnings have fallen to $209 a share for 2023. So that's a big reduction cut already. And to get back to just the long-term median of earnings growth in a recessionary environment, you're probably talking somewhere around 150, 160. So do the math. If you want 17 times earnings at $150, $160 a share, you're talking about 2,400 on the S&P. So stocks are not cheap by any stretch of the imagination right now. And one of the key defining points of a bear market, again, going back to this is a correction, not a bear market argument. In a bear market, you're reverting valuations back to long-term means. And again, this is a substantially lower price in the index than where we are right now.
Okay. All right. So again, watch carefully because the implications of what we learned could be very substantial from a price standpoint. All right. A couple quick things before I get onto CPI. One, I owe folks an apology from last week because we got great feedback on it, but I let it go way too long. We were almost 2 hours, and folks, a lot of folks here who encourage us to go even longer, but I also know other folks have a life and they have other things they have to do in a week besides just listen to this one specific video. So I'm going to try to be a little bit shorter this time around. You got my commitment on that. Secondly, I want to apologize too for my audio. I mean, as you can tell, I'm on the road. I'm using my computer's built-in mic here. I'd meant to bring a better mic along with me here. I'm sure the quality is not as good as normal. I know audio quality is really important to these videos. I do commit that the next time I'm on the road, I will have a traveling quality mic with me. But hopefully you guys can hang in with this. Hopefully the quality of the content is more important than the quality of the mic in this one. All right, Lance, so let's talk about the CPI. So September CPI came in yesterday at 8.3%. It was actually up 0.4% on a month-over-month basis. A Business Insider put out an article in the wake of the announcement saying that this print was the worst case scenario for Biden and stocks. And I think, for Biden, because it shows that inflation is under his watch, inflation is not getting under control nearly fast enough. And of course, there's only weeks left until the midterm elections. And then for stocks, it basically just suggests that there's going to be a lot more hiking and tightening ahead. And of course, that's not good for stocks, which of course is why it was so kind of crazy making when the market jumped as much as it did on this. And so anyways, let's get your reaction to the CPI print. But maybe if you can in your answer, can you sort of try to explain why we saw such a big positive reversal on what otherwise should be interpreted as pretty bad news?
Well, so again, we're dealing with a lot of lag effects, and in fact, there's now starting to be a chorus of economists coming out and saying, hey, kind of writing letters and stuff to the Fed saying you're really making a mistake here because you're hiking very aggressively based on lagging data. We talked about all this.
Which you and I have talked about all the time. Yeah.
And they're making a big mistake. This is going to be a huge policy mistake for the Fed because this last report was as bad as it's going to get. And it's going to get better from here. And very simply why is that starting in November, so going forward now, so as we get the November report and then December, January, February, March, we're now going to be comparing to 0.8, 0.8, 0.9, 1.2, big jumps in inflation because this is the time last year that inflation really started to take off. So now these year-over-year comparisons are going to be much more problematic in terms of printing a higher number. So inflation is about to start to come down fairly rapidly. But more importantly than that, that's just one component of this. The other component is that if you take a look at forward, inflation expectations, those are already coming down fairly sharply. And we need to talk about PPI with us as well, because we had import and export prices out this morning. But the important thing is that the big component, we've talked about this numerous times, kind of ad nauseum, the big component of CPI is housing rent. That is a very big lag that runs about a 3-month lag. That's about to start showing up. We know for a fact, right? Refinancings have dropped through the floor. We know that new purchases have dropped sharply. We know that rental rates have already come down. None of that's getting reflected into the CPI right now. That's
right.
coming.
And housing was actually the biggest contributor in this past month to the rise.
Exactly. From 3 months ago. And that's the problem. And see, this is the trap that the Fed's walking straight into. And, look, they've got 400 PhDs and they can't figure this thing out. I don't know what's going on, but look, they got to know that this is the case. And so I suspect that very soon we're going to start to see a little bit of a back off on some of this more hawkish language, because they've got to start repositioning themselves to start slowing rate hikes here sooner than later. Again, just because, we haven't seen any of the rate hikes so far actually impact the markets. That's all still coming. The only one we can technically maybe see right now is the first 25 basis point hike from March. The rest of them won't show up until January of next year. And those are going to get it now. When in November will be 4 75 basis point rate hikes, all just right on one on back of each other. But as I said, the reason we need to talk about PPI here in particular, because it was also, still fairly hot. But take a look at import export prices, huge drop in import export prices today. That was, which is showing signs of deflationary pressures starting, or I should say disinflationary pressures starting to come back through the system on pricing. That's going to start eroding away a lot of these other issues. Also too, right now we're watching all the retailers back up, Black Friday. Black Friday is now started in October.
Yes.
So, and the reason is these companies are trying to get rid of all this freaking inventory they racked up in 2021, thinking that all this demand was all organic. It was the economy's booming, right? We need to have all this inventory. And then the money ran out, and everybody's like, well, why do I have all this inventory? So now they're scrambling to try to get this inventory liquidated. So now's a great time to go buy stuff because you get some really good sales on stuff right now. But that's also disinflationary, right? That's all going to start kind of feeding through the system. So again, the point here is that, we've talked about, and look, inflation has peaked. It just hasn't collapsed yet. But there's a fairly significant decline in inflation coming. If inflation just prints about 2%, 0.2% each month going forward, so we did 0.4 this past week, but if we start printing 0.2, 0.3, inflation is going to be back down towards 3%-ish by mid next year. And so the question then is, what's the Fed going to be doing at that point once inflation starts to get back under control?
Okay. And you are given a little preview of a question that I'm coming up to here, which is, hey, is deflation really the bigger boogeyman that we should be worried about here? We're going to get there in a minute. I'm going to re-ask my question, Lance.
Could I answer it? Sorry.
Not the one I asked, but you gave a great answer,
Okay.
which is why. So I think everybody understood when the print came out yesterday and the markets plunged, and they said, okay, yep, more rate hikes coming, more tightening, bad for stocks. And then, of course, we had this massive reversal. So,
Sorry.
Some people have said, hey, that's the plunge protection team. Some people have said, nope, we were just so oversold. It was the rubber band snapping back. What in your mind explain that?
So sorry. I actually was answering that question. I just didn't finish it. So okay. The reason we had that sharp rally yesterday, look, my opinion only, and was the plunge protection team in. That's been the argument for every bottom ever made, right? But yes. First of all, the market was extremely oversold, extreme negative bearishness. Hedge fund positioning was extremely low. Record put, index options sitting out. I mean, you had all the fuel ready for a rebound rally. All you needed to have was something to spark it. It was going to cause a big short covering kind of frenzy. And yesterday morning, when that CPI came out, investors kind of saw through that, because it was all in shelter in terms of the increase, and now it's starting to become a more known aspect that rental inflation is about to come down. So again, I think a lot of investors, particularly on the institutional side, kind of look through that inflation report saying that was the last really bad report we're going to get, and I probably need to start putting some equity exposure back in my books, because again, end of the year is coming. They've got to have some exposure on their books. There's a couple of things coming up here that really kind of augur for a decent rally, kind of like we saw in July and August. First of all, the market is washed out on multiple levels, but corporate stock buybacks are in a blackout window right now. Those are going to start next week. That blackout window starts to fade towards the end of the month. So corporate stock buybacks will be back in play. Also, too, again, moving into November, December, all these mutual funds, hedge funds, pension funds, all that, they've got to have their allocations up to weight. So if they're holding a whole bunch of cash right now, they've got to have that money allocated by the end of the year. A lot of these mutual funds have a requirement they can't hold more than 5% cash or whatever. So all that money, that cash, has got to be put back to work before the end of the year. So I think there's a real setup here, in the next month or two, that we could see a very decent reflexive rally. You'll want to use it to, we've said this every time, right?
Yeah.
But you'll want to sell into it, just like we did back in July and August. But, again, probably an opportunity here for traders. If you want to put, so if I'm a trader and I've got, 2-month window, I don't have to worry about too much, I'd put a long position on here and trade it for the next 2 months. And then, as we get to 2023, that's where potentially kind of this next leg becomes problematic as a recession actually starts to show up in the economy.
Okay. So even though you and I have just sort of laid out a case for where earnings could really disappoint and stock prices could potentially go down a lot more if they're really bad, you're also saying, hey, there are just some, systemic seasonal reasons why we may still have a Santa Claus rally this year.
Yeah. Well, and again, look, earnings estimates have come down. Like I said, earnings estimates have gone from 240 to 209. You've had a lot of companies pre-announcing. So there's a potential here in this quarter. And again, this is how, so let's back up for a second, real quick. This is the game that's played out every quarter, which is Wall Street starts out at a certain number on earnings, and then they lower it until they get to a number that Wall Street can beat, right?
The bar can be stepped over, yeah.
Exactly. So I call this millennial earnings soccer, right? So because everybody gets a trophy.
Everybody gets an earnings beat.
Yeah, exactly. So this is why every quarter you have 85% of companies, whatever, beating estimates, right? Because you just lower the number till everybody can get over it. Well, we've lowered those estimates a good bit. Companies have already pre-announced. So there's a reasonable possibility here over the next month or so that earnings will be bad, but they won't be as bad as expected. And that's enough to get you a rally, particularly if you're fairly short in terms of your book, right? So so some bullish catalysts moving into the end of the year. Again, this is reflexive rally on it. I'm not talking about the bottom of the bear market. I'm not saying that at all, but less than, earnings that aren't as bad as expected, You got corporate stock buybacks coming out. Insider buying has actually been picking up lately. Insiders sell for a whole variety of reasons. They only buy for one reason, because they think their stock's cheap. So you're seeing an insider buying actually picking up here a bit. So you're seeing some activity here that suggests that, and plus there's just a shit ton of cash sitting out there, right? Every hedge fund, pension fund, mutual fund manager out there is just sitting on a wad of cash. And they, like I said, they've got to get that put back to work. So if this market starts to move, you got, a lot of negative sentiment that they'll reverse. You've got a tremendous amount of shorts sitting outside. So if prices start to move meaningfully, you're going to get a short covering rally. That's got a lot of fuel behind it right now because of the extreme negative short positions built up. Right. And then you have record index put options sitting out there that are all going to have to cover. So again, there's just, even though things are bad going forward and there is definitely downside to this market left, it doesn't mean in the near term, you can't have this kind of mind boggling, face ripping rally that just makes no sense whatsoever. And that's the rally that's going to sucker you off sides and get you back into the market thinking the bull market's back, and then it's going to smack you upside the head again.
Right.
So,
and that, yesterday was a great example. And then what you just said totally added a ton of validation to it of why we keep using the term like, treacherous for today's markets, because, hey, we may be right, we may be wrong. I think we agree that we feel fairly confident that the longer term market trajectory is downwards, that this correction or bear market hasn't fully played out yet, but there's potential reasons, if you said, for a rally for, either fund rebalancing reasons or cash that's on the sidelines. These guys have to deploy it, or the negative sentiment's too low, or shorts start getting squeezed or whatever. So, there's a whole bunch of things that could cause a reversal. But then there are days like yesterday, which the reversal happens in a way that's just like, doesn't make any sense to somebody on the day. And it's a total face ripper, right? And so the point is a market like this kills bulls and bears alike, right? I mean, it's really, really hard. And at the end of this, I'll remind everybody why, we think it's such a good idea to work with an advisor who's got experience in this, so that if you are, playing in the markets to a certain extent, or not playing in the markets, but you're deployed in the markets to a certain extent, you're benefiting from the experience and the wisdom of somebody who is conditioned to expect this. Because a regular person, this stuff can just happen that you can't imagine, and B, when you see it happening, you can't believe it. Exactly. But it doesn't matter because it's still happening.
Exactly. No, and this is, it's actually interesting. So on our radio show yesterday, I had Mike Leibowitz on the show with me, and we were talking about experience. And, there's so many investors in the market today that have never been through a real bear market. They started investing post 2008. There's a tremendous number of people that are writing blogs and newsletters and doing financial media, et cetera, that started their whole career in 2009, 10. I can name a few, but we just won't on the show today. Sure. But these are guys you read all the time, right? Stuff that you read on, you gotta be careful, stuff that you market watch, you see, and wrong with journalists, right? They're not managing a book of business. And a lot of those guys are really young too, and they've never.
Hey, let's do me a favor. Repeat those. You glitched a little bit, so I just want to make sure people get the names you just mentioned.
Oh, I'm sorry. No, so like Market Watch and CNBC, great media outlets, but those are a lot of the Wall Street Journal. A lot of those are written by journalists.
Right. And the writing staff tends to be younger. The guys that write the daily stuff.
Young. And they don't manage a book, right? They've got no capital at risk. So they're just writing about whatever's happening in the market, and they go interview some guys and they put together some quotes and write this article. Nothing wrong with that at all. It's a great way to get perspective about what's going on. And I'm not poo-pooing that you should not read those media outlets, because the information is good, right? But just understand the point that it's coming from. Experience is and there's a point to this, and the point to our conversation is Mike and I both have over 30 years of experience managing money. I started before the crash of '87. He started right before the invasion of Iraq in 1991. Went through the bond bear market in 1994. Long-term capital, Asian contagion, Russian debt default, .com crisis, financial crisis. We've been through all of those, right? And here's the important part of that. We have a ton of experience with bear markets, we've seen this before. What we haven't seen before is inflation running at 8%, right? This and the Federal Reserve intent on hiking rates. Every other bear market prior to this, the Fed was cutting rates into the bear market. This is the first time we're having a bear market cycle, and the Fed's trying to hike rates and doing everything exactly the opposite. So, this bear market, even with experience, is different than every other bear market we've had. And so it's the outcomes are unknown, and trying to navigate. And here's to your point, Adam, this is the toughest market that we've been in, management wise, and trying to manage money and make decisions for financial portfolios that we've been in, because it's such a different environment that, we haven't been in since the late 70s. And unfortunately, I was too young to manage money back then.
Right. I was going to make a crack that you actually did see market conditions like this, but you were riding a big wheel back then.
Exactly.
But
did they actually have big wheels back in?
They did. Of course, they had big wheels back in the early 70s.
I don't remember when those came out, but I didn't have one growing up. My dad. There was two things I wanted growing up: was a big wheel and Legos, and my dad wouldn't buy me either one of those. So.
Oh, really? I had my brother's hand-me-down big wheel, but it was around in the 70s.
All right.
But great perspective, because it shows that there are very few people still practicing who have experience, because it was so long ago we saw something like this. But you just talked about the experience that you have, and this is still a challenging environment for you. Compare that to the average person who doesn't have any, it's a fraction of the trading experience, trying to just go it alone, given that lack of experience, just doesn't, it just on the surface, just coming out of my mouth, it just doesn't sound like a super prudent approach to do. Anyways, we'll talk more about that near the end. But I'm looking at the time here, and I'm realizing to not make a liar out of myself, I think I'm like my second and a half bullet point out of like 10. So we're going to have to move on here. I want to quickly talk about a article that you just wrote, which basically is on that topic of, look, we're still so focused on inflation here, but you talked about that, hey, even if we kind of just let it do its thing, it's highly likely going to be down near 3% by the middle of next year. And that's if we just let it drift at current rate of momentum. Yeah. There are things that could happen that could bring it down a lot faster. Of course, there are things that could happen that could bring it up, but your article, I think, did a really good job of just raising the point of, hey, look, it is much more probable that the inflation issue will go away at some point, or at least get contained for one way or another. Fed's actions are just time itself. When it is, we are still left with all of the deflationary issues that we have had for the past decade, but literally papered over with all the stimulus and everything. This is the Lacey Hunt argument, right? Which is, we got to get inflation under control. But remember, there was a massive deflation dragon that needed to be slayed before inflation showed up. And so we still have a ton of work ahead of us on the deflation side. So I just want to note a couple of things. You get some great charts. I'll just mention each briefly. We'll put them up on the screen, and you can give whatever color commentary you want. You have a chart here of the federal funds 6-month change rate, which is basically shows when the rate of change in the Fed fund rates spike, something usually breaks. Yeah.
And it makes complete sense, right? Because, and by the way, if you go to our website, realinvestmentadvice.com, the article is today's article. Click on the Insights tab, and it's deflation is the inflation problem is likely to become deflation. And the reason for the whole article is exactly to this point, is that the Fed will break something. And when they break something, deflation becomes the issue. And so that 6-month rate of change, so all it is just take the Fed funds rate, you look at the 6-month rate of change and how fast is that increasing or decreasing. And not surprisingly, every time there is a very sharp rate of change in the Fed fund index and you're hiking interest rates, you break something in the economy. And whether, again, we go back, every crisis that we've had that Mike and I have been through, and we were just naming them, right? The 87 crisis, that was portfolio insurance. Then you had outside of the invasion of Iraq, which had nothing to do with interest rates, but you had the 94 bond market crash. Then you had the Asian contagion, the Russian debt default, long-term capital management, dot-com crisis. Every one of those that occurred at a time that the Fed was hiking rates. And so there's always this relationship between tighter monetary policy and some type of credit-related event. And at the bottom of the day, you may say it's a stock event, but at the bottom, at the end of the day, if you actually look underneath the surface, there's a credit related problem generally somewhere in that system, whether it's currencies or something else that is interest rate sensitive ultimately.
All right. Great points. I'm biting my tongue because I want to ask some more questions on that, but we got a lot to go through. So next chart. The next chart is the inflation index. And basically that shows that high inflation rates precede recessions and deflationary periods. If you look across, the span of history here, just another sort of indicator here of, we've sort of seen this movie before.
Yeah. And again, it's not surprising. And again, you can go all the way back to the 1700s, the 1800s. And, it's just the consequence of what happens. And we're going to, the point we're going to get to in a second is the problem or the problems that remain. And the problems that remain are all subject, ultimately, only with the exception of one of the items, is subject to interest rates. And, that's going to be the ultimate problem down the road.
Okay. All right. One more chart here. It's the chart of the long-term real interest rates overlapped with crisis events. And it basically says when real rates go negative, when they revert and start going back to cross the positive threshold, something breaks again. We have a crisis.
Yeah. And again, it's just, the problem is, okay, so real rates, just so everybody's on the same page, what real rates are interest rates adjusted for inflation. So you take the 10-year interest rate, you subtract out inflation, and that's how you get negative rates. So real rates. What negative real rates tell you is there's something wrong in the economy already. And this works identical to yield curve inversions. And Adam and I have talked about this numerous times. And right now we have the deepest yield curve inversion, the 10 versus 2 year, since the dot-com crisis, right? And so we've got a very negative inverted yield curve. That doesn't mean you're in a recession. What that means is that there's a problem in the economy, and when the problem in the economy becomes a recession, what will happen next is that yield curve is going to invert. The same thing that will happen with real interest rates, because that will revert as well back into positive territory as you recognize the recession or whatever it was that the Fed broke. Those real interest rates will revert back to positive territory. So very much, it's basically almost the same indicator as an inverted yield curve, but real interest rates tell you that there's a problem in the economy that's coming.
Okay. I had a little recession watch section down further on my list here. I was going to focus on that 10-2 inverted yield chart. So thanks. You already ticked that off. We'll cross that bullet off the list. All right. Well, we've got one last chart here, Lance, which is a chart that you pulled from Alf Peccatiello, who's been on this program several times in the past. Very smart guy, really understands the bond market well. Essentially, this is a table that is showing how periods of high inflation revert to levels of low inflation over 16 months or so on average here, right? And so, it just basically sort of suggests we should expect the same thing this time around.
Yeah, exactly. And again, as we talked about before, and what he really kind of brings out in this table is that when you have high inflation, I know everybody's like, oh my God, high inflation, it's terrible. It's going to be here forever. It's not going to be here forever. Inflation cures itself. High prices cure high prices. And that's just a function of the fact you get to demand destruction. And retail sales today is a good example of that. Retail sales came in flat. And this is in a month where everybody went back to school, right? So, I went and took my kids up to college and spent a crap load of money at Target, to get them, put into college. So despite all that, retail sales were flat, which is, showing you that there is this contraction in consumption that's happening, and that's going to continue to get worse. Again, Amazon had the second Prime Day of a year, trying to get rid of inventory, trying to get stuff moved, and also just trying to get people to buy stuff. So retail consumption is slowing down, and that's a function of that demand destruction of high prices. So again, you and I talked recently about credit card debt, which is just surging right now in terms of credit card usage. As consumers are just trying to make ends meet. So inflation is going to cure itself. And, to kind of cap this off, we'll get to this point in a second about why the 3Ds are so very important to where we wind up after this period in time.
All right. Well, why don't we go straight there?
So let's just jump right in. So the three Ds are debt, demographics, and deflation. That's the three big Ds. And, and we were talking about this earlier. It's kind of like Moses, when Moses was in the desert and he's leading all the Hebrews across the desert, and he gets to the sea and he has to part the sea so they can cross it, right? And that's kind of where we are right now, is that, we've got this temporary effect of, the sea being parted for inflation. But what's eventually going to happen is that, all that's going to come crashing back down. So, we can temporarily stall this issue by having inflation that was created by artificial means, right? We were sending checks to households, right? So we created this artificial demand, and we had no supply because we shut down the economy. So we got this inflation, kind of surging through the system, and everybody's going out and buying houses and doing all kinds of crazy stuff. Now, though, we're getting to the other side of the sea, and the sea's going to come crashing back down because we made the debt problem worse. We didn't make it better. We made the deflationary pressures in the economy is that we've made those worse by pulling forward an immense amount. We pulled forward 5 years worth of consumption in a year. So if you think about this for a moment, right? Adam's going to buy a new car as an example. So I give him, but his car is good right now. It's fine. He's got 3 years left on this car before he really needs to trade it in. But I send him a check and I go, "Hey, Adam, here's a check." And he goes, "Well, I'll just go buy a car now because I got money. I'll go do it now." Well, now he's bought that. So whatever consumption that Adam was going to do next year, the year after that, buying a new stove, a new fridge, fixing up the house, whatever it was going to be, all that got pulled forward. So now there's this giant void sitting there in the near future that's coming up where people go, "I've already bought what I needed. I don't need to go buy another car. I don't need to go buy another refrigerator or washer, dryer, or computer, or whatever." That's what's happening with the PC industry right now. And NVIDIA and others have come out and warned about PC sales here recently. It's like PC sales have just dropped dramatically. Well, yeah. Everybody went out and bought new PCs with their $1,500 check because they were all working at home and doing Zoom meetings. Take a look at Zoom stock, right? That tells you all you need to know about that pull forward of demand. So now the problem is what are you going to do for me now? And the problem is unless you're going to go back to MMT and sending checks to households to pull forward more. And look, every time you do this, all you do is pull forward future demand. And so you've got to keep filling that hole. And if you don't fill that hole, and as it comes up in the future with fresh printed money, you're going to keep getting these massive deflationary pressures on the economy. So that's what's coming. Next year, there's going to be a massive wave of deflation. Then you've got this demographic issue of people aren't having children. And so our demographic issues catching up with us. It's not just with us, by the way. It's Japan, it's China, it's Europe, it's everywhere. Right. And we've got this massive wave of baby boomers that are moving into retirement. They're going to start being net drawers of assets, out of financial markets.
And not productive workers because they've retired or aged out. Yeah.
Correct. And so you've got just these massive deflationary waves that are about to come crashing back down on the economy, as this, temporary divide of the sea, is ended.
That's a great analogy. As I hear you talk about it, I just want to make sure that I think in some people's minds, probably not our viewers, but in some people's minds, you almost sort of think of the two as like, opponents or opposites. Like, oh, we can offset some deflation with inflation, or inflation can keep the deflationary, waves parted while I'm going through here, right, as almost like, well, we can offset them, right? But really, they're both forms of borrowing. Deflation is because you have too much debt, right? And taking on too much debt is you are borrowing from creditors who want to get a return on that debt and want to get paid back, right? But inflation is borrowing from the future. You are borrowing prosperity from tomorrow. You are pulling tomorrow's purchasing power into today. Right. So it basically, you can't think of one thing as good and one thing as bad. They're really two bad things. Exactly. And you can use them at times to sort of hold each other off at bay. But it's kind of like, I'm kind of thinking of an analogy. It's like you got a bear in your house, so you bring in a tiger to try to get the bear out. But at the end of the day, you got a bear and a tiger now that you both have to get out of your house. I mean, it's not two good things, right? So probably a bad analogy, but hopefully folks got what I was talking about there.
No, I think it's a very fair point. And, again, we just, and two, just one last point on this about demographics is that, we've changed the whole structure of the economy. We used to be manufacturing based back in the 70s and 80s, and that's a very high multiplier effect. If I manufacture something, it requires a lot of inputs, commodities, materials, et cetera,
right.
Labor. It's a very high input. It has a multiplier effect of about 5 to 1. For every dollar spent in manufacturing, you generate about $5 worth of return out of that. Services business is almost negative. It has a very, very low multiplier effect, and particularly when it's debt subsidized, it has a negative effect once it's debt subsidized. So the problem is going forward is that we are continuing to import deflation from all these other economies, right? We want cheap products, cheap goods, we want cheap services, and so we export our labor, we export our inflation to import that deflation, and that's a cycle that's not going to change anytime soon. I know there's a lot of I loved President Biden just recently saying 2 words: "Made in America."
Yeah,
and it was a great gaffe, but the point was interesting because he was doing this at a Volvo plant, and he's talking about made in America, right? We need to bring this stuff back, manufacture in America. Sounds fantastic, except people can't afford it. And again, we talked about before the problems with labor and cost and efficiencies and all these type of things. And the way that we subsidize our lifestyles is by importing deflation from other countries, and that's going to be a trend that continues into the future because we can't afford to do it any other way. We can't really afford. It sounds great to go say made in America. We just can't afford to do it.
Right. Well, that'll be interesting because, right now there's a big movement to onshore and friendshore and whatnot, which should be raising underlying input costs just because of the labor and whatnot. But I sort of hear you saying like, yeah, they might want to do that, but they may very quickly realize that we just can't afford it because it's going to be.
But you hit the nail on the head. Friendshoring, right? That's not onshoring. Friendshoring is moving from China to friendlier other countries that have lower labor costs. So
lower labor costs than we, but probably higher labor costs than China or.
Bangladesh. I wouldn't bank on that though.
Okay.
Because a lot of these countries, we're moving to we're moving to Vietnam, we're moving to other countries, and those have very low labor. They may not be as cheap as China, but they're still very low cost relative to us because we don't pay 401k plans, benefits, healthcare.
Right. Well, we'll see. And just a super side note, had a really interesting interview with Mark Faber, who's always a phenomenal, interesting interviewer. And he specifically sort of called out Latin America as actually being potentially really well positioned right now. And so, if friendshoring is something that you're as an investor are thinking of maybe capitalizing off, Latin America definitely should be one of the areas on your consideration list. All right, look, I'm going to hop off this topic, but real quick, because CPI was up 0.4% here in September. I think that's the last input that goes into the calculation for the next rate that the I bond is going to offer. And I think that this pushes it up a little bit because CPI, so it's not going to be as high. I haven't done the math. There's actually a formula you can input all the CPI increases in to kind of get a sense for what it's going to be when it renews. I haven't done it recently, but my sense is it's going to be probably still above 7%, 7% or above. So just to remind folks, if you get an I bond now before the end of October, you lock in 9.62% for the first 6 months, and you should get 7+% for the following 6 months, meaning you're going to get a blended return that's going to be somewhere in the 8s, which isn't so shabby in this environment, especially as Lance is right, and the CPI starts coming down. That's going to be actually a really nice positive return for the next 12 months. So just making a little commercial there that for the I bond topic I've been talking about. And folks, if you haven't watched my video on the I bonds, I'll put up a link to one here. So you can go check it out. But there is some timing sensitivity now that if you want to lock in that 9.62% for the first 6 months, you got to do it before the end of this month.
Yep.
All right, moving on. So you mentioned this briefly earlier, but the 10-year interest rates are back on the rise, or sorry, yields are back on the rise with bonds. The 10-year is now back above 4%, or at least it was earlier today when I checked. And so this is kind of like what's going to break the system here. And that's actually the next topic I want to go into. But obviously, the higher that yields go, the more odds that something could really break. San Francisco Fed President Mary Daly just said that the Fed, she expects the Fed to keep hiking up until the 4.5% to 5% range, and then hold it there for a while. And so,
Yeah, well,
I know you laugh, but let's just assume they do that. Let's say they get the Fed funds rate.
We can assume whatever you want. We can assume Batman's real too, but hey.
Yeah. But anyways, that's what she says they're trying to do, right? That's the public plan of record. So, I mean, if the Fed gets to 5% of the Fed funds rate, which, then lots of things, it goes in an input that lots of other debt is priced against, and obviously at a higher rate than that. What's that going to do to corporate margins from a cost of capital standpoint, to zombie companies from just a, mass extinction event standpoint, to mortgages? Can you imagine mortgages with a Fed funds rate at 5%?
Yeah, you're talking 8% mortgages. So
at least, because we're not that far from 7%, and we're down here at 3%.
So no, look, it's so what I laugh at is, can they get to 5 on the Fed funds rate? Absolutely, they can do whatever they want. Are they going to hold it there? F-bomb, no. So, and the reason is because you're going to crack something. Look, today, as a matter of fact, Janet Yellen, the Treasury Secretary, was asking the banks, like, would you please buy some bonds, because we have no liquidity in the bond market. The bond market is on the verge of having real significant problems, because as interest rates go up, everybody's like, I'm not buying here, because rates are going up, I'm going to wait. And so there's this real lack of liquidity that's now occurring in the Treasury bond market. And this is hugely problematic if something breaks. And this is the thing you're going to see just before something does snap in the economy.
Okay, great. I'm going to interrupt you because this is where I was going. So let me just put up a couple of quotes and charts here for a second. I'm going to let you run wild. Okay. So there was an article that just came out from Bloomberg. The Fed's next crisis is brewing in U.S. Treasuries. Okay. Here's a quote from the article. The word crisis is not hyperbole. Liquidity is quickly evaporating. Volatility is soaring. Once unthinkable, even demand at the government's debts, even demand at the government's debt auctions is becoming a concern. Conditions are so worrisome that Treasury Secretary Janet Yellen took the unusual step Wednesday of expressing concern about a potential breakdown in trading, saying after a speak in Washington that her department is, quote, worried about a loss of adequate liquidity in the $23.7 trillion market for U.S. government securities. Make no mistake, if the Treasury market seizes up, the global economy and financial system will have much bigger problems than elevated inflation. So the article has a couple of charts. I'm just going to put them up here really quickly. This chart here is showing the heightened lack of liquidity in the market. That's the chart on the left here, and this is sort of an inverse chart. So the higher the chart, the lower the liquidity in the markets. And you can see we are at an all-time high for the data series here, which goes back about 5 years. And then you have the Bank of America Move Index here. This is a measurement of volatility. This is a direct measurement. So higher chart means higher volatility. Again, this is at a data set high here. And then there was a quote in there from a long-term government bond trader who said, we need to find a new marginal buyer of treasuries as central banks and banks overall are exiting stage left. Right. So he's basically saying the guys that were buying all these bonds are sitting on their hands now. They're leaving the building. We need to find somebody else to buy this stuff. So here's a chart that accompanies that, which shows the holdings of treasury and agency securities by banks. I'm assuming there's central banks in here, but there's certainly just regular financial institution banks in here. And you see that they peaked right at the start of 2022, and they've been coming down since. How much further? I don't know. We're going to find out. But back to this, to you, Lance, just size this up for us. If the U.S. Treasury were to seize up here, just how nuclear would that be?
Well, basically, is if you can just think about the way we operate in the world, everything is on debt, right? Where, credit is literally the lifeblood of the economy. And at the bottom of that, yeah, corporate bonds, those are important. Obviously corporations taking out money, et cetera. But at the end of the day, it's all about the treasury market. Think about that, right? $27 trillion is the treasury market.
It's mind-bogglingly big. I literally cannot conceive of how big that is.
The entire US economy is only what, 21 trillion in real terms. So, you're talking about the bond market's bigger than the US economy. So if that seizes up, imagine all the stuff that stops working. Credit card rates are tied to, short-term T-bill rates. Mortgages are tied to the 30-year mortgage rate, and the 10-year treasury rate affects that as well. So, all these things that, and again, when you're doing transactions in the economy, taking out a mortgage, what happens with a mortgage, right? So you go to get a mortgage, the bank loans you the money. What do they do with it? They take that loan, they package it up into a mortgage-backed security and sell it off to the market. Well, if that market's frozen up and nobody's buying it, who are they going to sell that mortgage to? Right. So you just start freezing up all kind of the entire lifeline of the system just starts breaking down. And it's very much like what we saw with Lehman. Lehman's bankruptcy was not the problem, right? Lehman going bankrupt wasn't the problem. The problem is that everybody stopped trading with each other because nobody trusts anybody. They're like, I'm JP Morgan and you're Credit Suisse. How do I know you're going to be in business tomorrow? Lehman just went out of business and I'm stuck with a bunch of their stuff, right? So everybody just stopped trading. And when everybody stopped trading, the economy just shut down. That's the risk. And it's a phenomenal risk, to the overall economy and functioning of the markets.
Yeah. I mean, here's a question is there any bigger risk?
No,
I mean, financial risk, right? Yeah, sure. We can go to nuclear war, but beyond that, this is that in finance, right? If the treasury market doesn't work, nothing works. Right.
And look, we just talked about the $120 trillion worth of whatever the number. There's a tremendous number of derivatives out there that are tied to treasuries of some sort or magnitude, right? There's mortgage rate derivatives, there's treasury derivatives, interest rate derivatives, derivatives on top of derivatives.
Right.
All tied to treasuries. And so if the treasury market goes, all those derivatives go too.
It's a Hindenburg moment for the derivative market.
And again, I don't think anybody is paying near enough attention to that potential risk. And look, I tell you what, right now, if you take a look at the 10-year treasury, take a look at TLT, it's actually been bottoming here lately. It's been moving up and down, but there's been some marginal buying in bonds. One thing that's been kind of going on over the last week or so is this issue with Bank of England. Today's the deadline for the Bank of England. They're supposed to have whatever their problem is worked out today. The Bank of England said, we're going to buy bonds through the end of Friday, and you need to have your stuff straightened out. So whatever their margin call problem was, they're supposed to have it solved. They didn't get it solved. I'm pretty sure they didn't get it solved. We'll see if the Bank of England is still buying gilts next week. But that pension problem is the same pension problem we have here. We've talked about this before, right? These pensions here in the U.S. are not only long treasuries, but they have levered up on treasury bonds, mortgage bonds, muni bonds, et cetera. So, there's that same pension margin call risk is here as well. And again, like I've talked about before, this inflation fight by the Fed is fine and dandy, and they can do it all day long until you get financial instability, and then that game's over.
Right. Well, this is why you laughed on Mary Daly's thing, where you're just like, look, there are bigger bullies, bigger monsters out there than inflation, and at least as far as the Fed's concerned. And if one of these guys shows up, they're going to have to just drop what they're doing in inflation and fight this instead. And what's interesting too is you talked about foreign markets like the UK. We talked about how when things were crunching in the UK gilts market the other week, that we did see some reverberation of that here in the US, and you would expect, as we're a hyper-connected global economy at this point in time, right? But the US is the biggest dog on the block, and the US Treasury market is by far kind of the biggest market that the US operates in, right? And it's the risk-free asset around the world, right? And it's what provides liquidity around the world. So if that market were to seize up here, it would be disastrous here, but it would be even more disastrous in a lot of other countries around the world. And so there would be this domestic shock from it, and then that would hit the other countries, and then dominoes that would break there would then come back here. So there'd be like a second shock wave of the repercussions that our breakage of the Treasury market caused outside of the US, again coming back to hitting us here. It just means that this problem would like compound, as the shock waves reverberate around the globe.
That's absolutely right. And that's this is the whole issue that I really, just honestly, between you and I, that I just don't think that people really have put into context as to what's going on. It's fine to hike rates, but there is so much debt globally, not just domestically, but globally tied to rates. I just don't think people have really given it the proper consideration as to when something breaks, it's going to be bad.
Yeah, and I think it is notable here that Janet Yellen, who used to run the Fed, now runs the Treasury, is now beginning to put the word out, right? That, okay, there's trouble in the Treasury market.
Yeah, and
right?
and look, the banks are criminal enterprises. Let's just start with that right now. JP Morgan, Wells Fargo all just announced earnings today, and they're like, oh yeah, we've had massive increases in net interest income. Well, yeah, you're getting, on your overnight excess reserves, you're picking up a very, very nice yield that you're not passing through to money markets. So they're just sitting on that spread right now, raking in cash. But they're not the marginal buyer. The marginal buyer is the Fed. And when this thing breaks, the Fed is going to go from QT to QE, and they're going to have to do a lot of it to try to stabilize the bond market. Well,
and I mean, to be honest, this is sort of revealing exactly that, right? Which is that the central banks are now in tightening, or trying to be in tightening mode. Is a good example of the Bank of England. They were hoping to, but couldn't. And what happens as a result? The Treasury market starts going into cardiac arrest, like atrial fibrillation, which shows that they've just been keeping that thing alive the whole time, pretty much, right? So, all right, I don't want to. I've got another rant for us. I do want to note really quickly, what happens when the Fed buys assets from banks is it takes the assets onto its balance sheet, and a lot of times in the past it's taken really junky assets, but given the banks top dollar for it. And that money that it gives the banks, in most cases, the bank doesn't lend out. The bank actually just turns that money right around, hands it right back to the Fed, and earns interest on it as excess reserves. Yep. So it's literally risk-free. It's like a risk-free annuity coming to the bank for not having to do anything except let the Fed buy its junky assets, right?
So criminal enterprise, remember?
Criminal enterprise. We should probably rant on that in more depth at a later date. But I do just want folks to know that when you really understand how much money the banking system makes from the Fed on this interest on excess reserves for doing jack all, it's enraging.
Yeah, let me give you a number: 500 million a day. And this is the problem for the Fed right now. So the Fed's created their own problem. So how much time do we have before, if I may blow your rant for the day? How much time?
We are already so tight on time. So make your point.
You have 5 minutes.
Oh God.
Give me three, because this
I'll give you three. Go for it.
Give me three, because this is really important. So what is quantitative easing? Quantitative easing is where the Federal Reserve buys bonds from banks. Now, look, the Treasury issues debt in order to pay for excess spending that they can't cover. They cannot sell bonds directly to the Federal Reserve. They have to sell the bonds to their primary dealers, which are all the major banks. It's 20 major banks that basically are the primary dealers. So the dealer buys the bonds. So JP Morgan buys $1 billion worth of Treasuries at auction. They turn around during quantitative easing process they turn around and sell that bond to the Federal Reserve, who credits their excess reserve account. So there's an asset swap. Nobody's buying anything. All they're doing is swapping assets. The Federal Reserve gets the bond. They credit the excess reserve accounts of the bank, and then the bank uses that to go trade in the proprietary market. They're supposed to lend it out, but they don't do that. And that's why it never boosted economic growth. But here's the interesting thing with the Fed. The Fed now owns the Treasury bond. The Treasury issues the interest payment on the bond, which now goes to the Fed. This is now an expense on the Treasury bond for the US government because they paid out that interest. They have interest expense coming out. The Federal Reserve gets it. At the end of the year, they remit that interest income back
to Congress,
or their excess after they paid off their interest on the reserves. But when it was a zero, they weren't paying anything out. They remit the balance of that back to the government as revenue. Now, this is important because even though we're washing the same dollar, it counts as revenue coming into the government, which covers some spending that the government wants to do. So if they want to go spend, $50 billion a year on some project, there's money coming in to cover that, which means that there was less debt issuance having to be made because of that interest revenue coming in. Mm-hmm. The problem is now is because the Fed hydrates have now screwed themselves. They're now having to pay all that money out to the banks and more. So there's actually a net deficit of the money coming in, because remember what the Fed did over the last few years is shorten the duration of their whole portfolio. So they don't have that many long dated treasuries anymore. It's a lot of bills and shorter duration bonds. So those are paying less interest because they were from previous low interest rate periods. So they're now paying out more than they have money coming in, which now requires the Treasury to issue more debt to cover spending. So this is actually making our deficit situation even worse because of what the Fed has done. But this is what quantitative tightening is doing. And when then eventually they're going to have to go back to QE in order to bail this out. And they're going to have to buy a lot of long dated treasuries to try to solve that imbalance.
Interesting. And it's probably one other reason why, sitting in TLT or in a long bond will be good when that happens, right? Because you've got the Fed back as the marginal, maybe even price insensitive buyer, just trying to pick up treasuries again. Yeah. All right. So I do want to get to trades that you guys have done over this past week real quick. I just want to do a super quick detour through housing. There's a table I'm going to put up here, and we already talked about, the carnage that we think rising interest rates is continuing to have in the housing market. We talk about how there usually is a phase that a process you go through before prices come down a lot, right? You see inventory start piling up on the market. You see people pulling listings as sellers try to go on strike and delay the inevitable. You see the bargains, they're not reducing the price, but they're making other breaks and gimmies and stuff like that. And then finally prices really start coming down. Well, on the inventory side of things, it is really beginning to explode. Here's a chart from Calculated Risk that shows the year-over-year increase in inventory in most major metros in the US. Back in January, this number was like negative 26%. Just still incredibly hot housing market. It's now 53% year over year average across these major metros. So
Well, no, I wrote articles last year because everybody was like, the housing problem, it's going to be a problem forever because there's a shortage of housing. And I wrote this article called 3 Reasons There's No Housing Shortage. And there is no such thing. It's a myth. So, because again, as soon as something breaks, in the economy, you get a lot of inventory really quick. So,
and you've said that a lot. I do want to commend you. You have said that a lot. And lo and behold, voila, here's inventory.
It just cracks me. There's another guy out recently just saying, it's like, higher mortgage rates don't affect home prices. Take a look at this chart of home prices. And of course, it's a very long-term chart and you can see the dips in home prices, right? But it's like, it doesn't really affect them until you zoom in and look at year-over-year rates of changes and you see these house prices just go through the floor. But, it's how you want to spin stories, right?
Yeah. All I want to do is just put this up here as a milepost to what we've been saying, right? Yeah.
It's the housing. And look, I'm renting a house right now. I'm licking my wife is shopping every day for a house. I'm like, babe, you're way too early. Give it another year. So.
And hopefully just folks, I'm trying to line up, and I think I've got it, but I'm trying to line up a conversation with one or two, ideally, auto loan market experts to get a sense of what's happening in the auto market. But even not having had that interview yet with those guys, I do feel pretty confident in saying, just like Lance said, wait a year, you're going to get a much cheaper house. I think the same thing's going to happen with cars.
Oh yeah.
All right. So let's get to your trades for the week, and then we'll do a little bit of our, veering off into some other non-financial directions.
All right. So trades of the week, we're just starting to do some cleanup a little bit for year end. So we trimmed off. We talked about 3 weeks ago, I guess 3-4 weeks ago here on the show, that energy prices gotten really oversold here. We were expecting a pretty strong rally in energy stocks, and we had added to some of our energy exposure. Well, we trimmed that off this past week. Just reduce those. They had gotten out. They had become more than their weight in the portfolio, so we just trimmed them back to weight.
That trade actually happened the way that you thought it would.
Yeah. And so we just took some profits off that, reduced those. We're starting to go in and do a little bit of tax loss selling as well. So we had put on a couple of hedges for the portfolio. We did one with the euro and also one on. I've drawn a blank, but we had 2 positions. Anyway, but we had 2 small hedges in the portfolio. We sold those at really slight losses. We took a bunch of gains at the beginning of this year because we went into this year at 70% equity rate. So we were 10% overweight equity coming out of 2021. We had reduced that to about 35%. So we took a lot of gains. So we've got a lot of gains sitting on our books. And so now we've got, over the next month or 2, we're going to use this rally to harvest some losses and kind of do some tax loss rebalancing for the end of the year. But there's some really interesting, things that are coming up right now, because there's a lot of stocks trading at really, really deep discounted valuations. When we sold the FXE position on the euro, we actually swapped that for a small position. We added to our position in Duke Utilities, Duke Energy. Stocks carrying a very low PE with a high dividend yield. And there's a lot of stocks like that are sitting out there. And over the next few months, one of the things we're starting to do is dig into a lot of these very deeply discounted companies that are trading at very deep valuations with very high dividend yields. And so one of the things coming out of bear markets historically is that you can build a portfolio with a 4.5% to 5% dividend yield. And I think that'll be the case this time as well.
Great. Okay, great. All right. So, anyways.
And by the way, I can't remember we had 2 trades and we did FXE and one other one. I'm drawing a blank. But if you go read our newsletter, I post every trade every week at the bottom of our newsletter. So. Great.
So if folks want to find that elusive ticker that Lance can't remember, just go there and find it there.
I'm getting old.
No worries. Well, look, as I mentioned, I'm at the New Orleans conference. I just wanted to share a little bit of feedback here for folks. It's been great. I was at this conference last year, and at that point in time, Wealthion was probably about 6 months old, and it was the first time where I'd gotten recognized from being on Wealthion. And there was a very, very nice group of people who came up and talked to me in the hallways a couple of times, who watched this channel and wanted to chat. But beyond that, I was still pretty much under the radar, I think, of most people that were attending here. Totally different story this year. It's been wonderful. It's been incredibly humbling. Just lots of people stopping me in the hallways. It's been a challenge sometimes to get to meetings because there's just been so many people who want to talk about Wealthion and the interviews that we're doing here. It's really been wonderful. Lance, a number of people have mentioned how much they enjoy these weekly market recaps. Your name has come up a lot here. I hope your ears are burning. What's really been meaningful for me too is the attendees have been very complimentary, but the speakers have been as well. I've just been surprised at how many of them have told me, I listen to your channel every week, right? It really has blown my mind. So anyways, I hope everybody watching this feels the success that this channel is having, because, as I'll talk more about in a second, this really is a people's movement. I am just an instrument here, and really 98% of my job is just listening to what you guys are telling me in terms of who you want to have on this channel next, what topics you want to have covered. And on that vein, a number of the people that have stopped me here have given me suggestions for new content. There've been some great ideas. Love to hear directly from the people that watch this channel. I've already got some plans in mind from what I've heard from folks here at the conference. But if you're watching, and you've got strong ideas of topics, speakers, format changes, et cetera, you'd love to see, please let us know in the comment section below, or you can send an email to info@wealthion.com. I really do listen. I really try to read every comment that we get, because as I said, this is a creation really of what you guys are telling me you want to see in the world. There've been a couple highlights I wanted to share with you, Lance, and with the viewers obviously too, but I think you'll enjoy them as well. One was one of the first guys to come up and introduce himself to me was an Australian guy who flew here all the way from Australia. And he said, "Hey, Adam, look, don't get a big head. You're not the only one I flew out here to see, but I've got a very short list. You were on this because I'm a big watcher of Wealthion." And it's wonderful to hear that. But it turns out he's a financial advisor like you are, Lance, in Australia. And I have had, short of Canada, Australia is the country that the most people ping me about on a weekly basis to say, will you ever please have a financial advisor in Australia for us? It's been a hard road for me to locate a good one. This guy and his firm seems to be very like-minded, and so we'll be following up afterwards, and hopefully he's going to provide a fast track to Wealthion being able to have a specific good financial advisor to recommend in that country. Secondly, I went to a great dinner the other night. It's just sort of a fantasy dinner. Rick Rule was sponsoring it. I sat right next to George Gammon and a couple other folks. Great conversation, but one guy sitting on the other side of me was a researcher, and we were kind of getting to know each other. And middle of the conversation, said, "Hey, Adam, watch Wealthion. It's a great channel. I really watch it a lot." And I said, "That's fine. Yeah, look, you don't have to butter me up. I'm sure you're a busy guy." And he said, No, I actually do a lot of my research. Like, I use Wealthion as a source for a lot of my resource because you've got so many great experts on there." So that was a real personal high, just to know that some of these guys who are on stage and, very clearly some of the top talent here are using these conversations to mine for insights that they use to actually put their own research together. The last one was a great one, and this is the one I want everybody to really listen to, is because this is what matters the most to me by far. I was walking down the hallway, kept getting stopped by people who wanted to, talk, and there was a couple who was very patiently waiting, and they finally came up to me and said, "Look, we know you're trying to get somewhere. We don't want to keep you. We just want to thank you because we love the program. But we ended up switching to one of your financial advisors at the beginning of the year." These guys, in their case, Lance, they were in New Harbor because we were just getting the relationship with you started up. And they said, it had gotten to the point where their old advisor, where we were just feeling like we were sharing our concerns, but he was just dismissing them. We were deployed much more long and speculatively than we felt comfortable with. Long story short, we moved to the guys in New Harbor. It's been a great relationship, but we've just done the math on how much that transition saved us versus if we had stayed in the same stocks we were in before and ridden them down to where we are right now. And it was just so gratifying to hear what a big, real, immediate, direct improvement, that made in their life in terms of capital saved, right? And what was wonderful about that is I was going down the hall because I was actually trying to meet Mike Preston from New Harbor, who's also down here as well. So I had the opportunity to bring them with me and to actually introduce them face to face with Mike for the first time. They talked with him, but they'd never actually met with him. Yep. So, again, Wealthion, we created it to help people build wealth by basically giving them access to great experts so that they could make more informed decisions about how they want to build their wealth and protect and grow it. And so to hear these firsthand stories is just super gratifying. And I'm taking the time to share it here because I just can't underscore enough that this is a people's movement. It is created by the viewers of this channel with our great experts like you as well, Lance. And so I'm the guy who gets the pleasure of getting to hear all this stuff, but really it's all of you that deserve all the credit for this. So I hope everybody's taken that to heart. I've got one more nice thing to say, but before I get there, I do want to get to today's rant. We'll keep it really quick. Lance, I'm sure this totally burned your bacon when you heard this. Ben Bernanke is getting a Nobel Prize for his courage to act in the 2008 crisis.
Yeah, if you actually go to my YouTube channel where we do our radio show and go to Tuesday, I think, and listen to the last segment of the show, I did a whole 15-minute rant on this whole issue. But here's the bottom line: yes, he did the research, and I love what the Nobel Prize committee said. They said, he saved the banking system. right? Single-handedly, he was the guy. He was the arsonist that showed up as the firefighter later to put the fire out. And,
Exactly.
and you're now giving this guy this Nobel Prize for basically, creating the crisis and then bailing it out. And then not only bailing out the banks, made them worse. They were 40% of the banking sector before we went into the financial crisis. They were a criminal enterprise then. They were foreclosing homes on people whose they didn't even have the mortgages for. They were forging mortgages in the background to spin them off into mortgage-backed securities. I mean, there's just numerous, criminal acts that occurred by these major banks. Nobody ever went to jail. Nobody ever, paid heavy penalties. And the Obama administration actually allowed them to shave off the whatever penalties they did pay, which were small taxes basically on the amount of revenue they made. The Obama administration said, I'll tell you what, if you'll donate money to these, kind of liberal organizations, we'll even reduce the penalty you were going to pay even further. So, this was just a slap on the wrist for these banks. Now they're 60% of the market. They're still heavily influenced because they're members of the Federal Reserve. So again, as we were talking about earlier, they get massive amounts of money from the Federal Reserve, all the time through these overnight excess reserve accounts, et cetera. So again, if we would have allowed what Ben Bernanke should have allowed to happen in 2008 was to allow the banks to fail, work them through a system of dissolution by say, JP Morgan, sorry, you screwed up. That's your bad, not mine. What we're going to do is take all your accounts and we're going to spread them across all these other FDIC insured banks around the country. We're going to have a much more diverse banking system. And yeah, sorry, you kind of screwed your shareholders and bondholders, and they're going to have to pay the penalty. You don't turn around and bail out the bondholders. You don't bail out the shareholders. You just made the situation worse. And now we've institutionalized this activity of too big to fail. So now it really is a problem that going forward, we will continue to fund these criminal enterprises to take advantage of the average American. And even look at what's happening today. Again, as we said earlier, they're making a killing on overnight excess reserves and not sending that through to their savers who, through fractional share banking, that's where the money comes from. Their savers aren't getting paid the interest on the money market accounts.
Right. And on top of that, too, there was all those steps that were taken during the crisis itself, Lance, right? But then there were years after that of creating QE forever, right? Each of these QE driving interest rates down to, did he drive to zero first? I think he might have driven it. Yep. So, all, Yellen basically did was just keep playing the Bernanke playbook, right? Yeah. I mean, he not only did all of that in the heat of the moment, but then he created all of the instability. We're worried about a financial instability moment now, right? We're just talking about how vulnerable the Treasury market's looking here, right? He's the guy that created the instability through that playbook, right? Yeah.
And look, and everybody's like, well, Powell's different. No, Powell's not any different. He did the same thing in 2020. Cut rates to zero, 120 billion a month of QE, did the Ben Bernanke playbook all over again. And this is the most, laughable point of all this is, these banks go through these regular stress tests and they go, oh, all the banks passed the stress test. So if there's another downturn in the economy, they're going to be fine. Well, if that's the case, why are we continually have to bail them out every time there's a downturn in the economy? And we bailed them all out. We were bailing out the high yield bond market in 2020 because it was impairing the banks. This is only a function of time until we're bailing out the banks again because of what's going to happen to the Treasury market. So if they're so financially freaking healthy, why do we keep having to bail them out every time?
Right.
God, at the taxpayer's expense, by the way.
Yeah, we're getting tight on time, but I asked this question anyways. So I'm asking you to just totally speculate here, but how different would today's world be if we had handled 2008 the way in which you think we should have handled it?
You would have
big banks died, mid-cap banks step in, take over their business. It would have been painful in the short term, but we'd hopefully have a healthier system afterwards. Like how much more different do you think it would be now?
Well, first of all, the market wouldn't be at 5,000 or 4,800 at the peak. It'd have been around 2,700, 2,800. Mm-hmm. You'd have a much more diversified system in terms of the financial system, much more competition within the system. So all of a sudden now banks are competing for business, which is the way it should be. You wouldn't have these big conglomerates basically driving the system.
You probably wouldn't have had nearly as much of an asset bubble, right?
Correct. And then your wealth inequality would have not gotten to where it is now as well. So, again, the problem has been all along for the last decade that all this money, and again, I'll make this very short, but all this money from QE went into the major banks. The banks were not loaning that money out. The whole point was with QE is they were supposed to loan the money to the banks. The banks were supposed to loan it to the economy, get businesses up and going, get people borrowing money, spending money in the economy, developing businesses, hiring people, doing all that. That's what created that wealth equality that you want out of capitalism. Instead, we created a corporatistic environment based on share buybacks and fueling corporate executive salaries and pensions through the stock market acquisition. That's not what the Fed intended to happen, but that's what did happen.
Yeah, and I don't want to go all creature from Jekyll Island, but I don't get this. Well, the Fed intended this, but the banks didn't do X. When you realize that the Fed is actually
owned by the banks.
Yeah, it's a whatever you want to call it, a conglomeration of banks.
Yeah. Well, I mean, look, but this goes back to 2008 when all the member banks were sitting around the table with the Treasury Secretary and the head of the Federal Reserve at the time. And basically said, hey, if you don't bail us out, the whole world's going to come to an end. And they freaked out and said, okay, we'll bail you out. And, that was the beginning of the end. Instead of saying, nope, you figure it out. You're the one that got yourself in this situation. I mean, we bailed out Goldman Sachs, got bailed out entirely from their exposure to AIG.
Yeah, it's ridiculous. It's so incredibly favorable. Yeah.
Yeah. Because they're sitting on the board of the Federal Reserve. I mean, it's just, it's all this, the Federal Reserve should be an independent entity, has nothing to do with the banks. They should be regulating and overseeing the banks. The banks should not be members of the bank. As soon as you put those two together, you've got too much conflict of interest in there to make rational decisions about what to do with your banking system.
Yeah, it's yeah. All right. So
we could do a whole show.
We could do a whole show on this. And the only point I say when we leave here is there are people like us, not patting ourselves on the back too hard for this, but who at the time were saying, look, this is the wrong policy and it is going to distort things even further. And it's just going to basically delay the reckoning that needs to happen and increase its magnitude. So we're basically trading off having to take the full pain today for having to take a lot more pain tomorrow. And I think here we are where we're now threatened with taking the much larger pain today. And probably the policymakers are going to do everything they can to try to push it off a little bit further if they can handle it. But of course, you can't do that infinitely. And at some point, you just have a really massive, horrible breakage. All right. Let me end on something. Finish.
Just call it what it is. Just call it what it is. That's deflation. And that's coming. So.
Okay. Yeah. All right. All right. So real quick, just to try to end on something that's not a total rant. I just want to talk for a minute about sort of opening yourself up to serendipity. And I'll give an example of this. But a huge part about success in life is hard work. Right, got to put in the hours. You got to do the hard work, but a big part of it as well is when serendipity comes knocking, putting yourself in a position to let it come knock on your door, and B, to be open to opening the door for it when it happens. And here's just a quick little example. So I was flying to this conference. I'm sitting in economy. Guy next to me in the middle seat. He's watching his video. I'm prepping for the conference. We don't talk to each other. As the plane starts landing, his movie's over. I'm getting my stuff out. We realize we're both heading to the conference together. Turns out this guy is Tom Calandra, who is a newsletter writer in the space, but he was one of the founders of MarketWatch. Mm-hmm. And all of a sudden, I'm like, I've got this financial company that I'm trying to grow, and all of a sudden, I've got guys sitting next to me who's got one of the biggest success stories ever in creating a financial media company and, launching it into the world. So we had phenomenal discussions. I'm definitely going to be, in touch with him. He's a super, super nice guy. But, I just could have just been heads down and I'm on a plane. I'm not going to talk to this guy. And I could have missed one of the biggest, opportunities just sort of fall in my lap. Right. And I've actually got another story that I'll tell later on. It's too long to tell for the time we have left, but Lance, we were going through kind of our list of things that, we would tell a younger person, starting off in life. And one thing I've seen an awful lot is, they say it's better to be lucky than right, in life. And I guess it is, right? If you're lucky enough to get that winning lottery ticket, all right, great, right? But as you have said, oftentimes you create your own luck, and you do that through hard work, but you also have to do it by to put in the hours to generate the success, your success. You've got to really kind of tunnel focus in and focus and do what you got to do. But you also then have to practice the process of stepping back and widening your view at times, and pausing and opening the door for opportunity to find you. Because if you're too tunnel visioned, opportunity can buy all day long, but you're not paying attention to it, right? And I'm sure you've got an example or two of this in your life, but this was a really important reminder to me of, why I've got to, in building this company, I've been heads down an awful lot of the past year and a half of its lifetime. But taking the time to come to some of these conferences, but more importantly, just take the time to, give the guy next to you at least a few minutes of your time, because you never know where it may lead, can be incredibly valuable, but you got to be willing to do it.
No, it's true. And you're right. You make your own luck. There was a really interesting article I was reading the other day about the 3 tips for startup companies. And, one of the tips was, one of the mistakes that people make is they go, okay, I'm going to start this business or whatever I'm going to do, but it's got to be perfect before I get it out the door. And so they work on it, they work on it, they work on it, they work on it, and it never goes out the door because it's never perfect. Right. And
that's called making perfect the enemy of the good.
Exactly. And the opportunity that may have existed for that product or service at the time passes you by, right?
Maybe long gone by the time, your perfect thing is out. Yeah.
Exactly. So the point is that you've got to create the way you create your own luck is just take the risk. You've got to get something there that's marginally good, and then get it out there and let the feedback come in, kind of like you did with Wealthion, right? You start putting stuff out there, you take feedback, you change it, you adjust. That's making your own luck. You build your own success by giving people what they want. But the only way you do that is by getting a product out there and saying, hey, what do you think about it? They go, I hate this product. I'd rather do this, this, and this. And so you do those things. And then all of a sudden people look back and it's like, wow, he was really lucky because he built this company. Well, they always say that overnight successes were built over 10 years.
Right.
But that's it. Everybody else is going to look at this thing and go, wow, that was an overnight success. You're in the background. You're going, no, I've been working on this thing freaking forever. But that's creating your own luck. And again, people look at a lot of things and say, oh, well, he was just lucky. No, it took a lot of work, but you've got to get out there and take that risk of failure. And I can't tell you how many times I've failed at stuff, but that's just part of the process, and you've got to be willing to do that.
Yeah, it's a very important point about iteration. And even here, I've had more than one person come up to me and say, "Oh, I've been watching you from the start, and gosh, you've gotten so much better." And I know it's offered as a compliment, but it
hurts.
It hurts a little bit. No, but it's like, wow, it must have been a lot worse than I thought when I started this out. But it's totally true to your point, which is, you get out there and you just start trying, and you kind of gravitate towards where the market is telling you it wants you to go, right?
So real quick things, right? So three steps, 3 things. This is what was in the article. Surround yourself with really smart people. Don't try to do everything, right? Work hard, put your head down, do your job. And then of course, get your product out early and accept failure as a consequence, and then build on that to build success. That's the 3 steps.
That all makes great sense. And the last thing I'll add to this is you and I have talked about sort of the importance of prioritizing your health, right? And just making the time in your day schedule to fit it in, right? And of course, the challenge, the other voice that echoes in people's ears is, I'm too busy. I don't have time for this, right? I can't take time for myself because I got all these obligations. And, you and I have talked about, no, actually the much better long-term return comes from making the time to do that, right? So you ever listen to Tim Ferriss's podcast, right? And
Absolutely.
He's the famous, Team of Titans, book that he put out. I've listened to a lot of his past podcasts and read his books. And one of the things that always stuck with me, I cannot remember the CEO, but I heard it from more than one talking to him, where they talked about the importance of meta time, which is, it's not structured meetings. It's not working tunnel vision, heads down on a particular project. It's much more the lean back of like just letting my brain kind of just poke and prod at my strategy and my vision and what we're doing, and just kind of looking across the business at a very high level, and maybe having a couple of discussions with interesting people just to see where they go. Right. Mm-hmm. Where he's like, I've heard this from so many entrepreneurs. I spent, years just doing the daily grind. If I just worked a little harder, then the next, degree of success would come. And yeah, you have to have that. But the big advances come from the meta time, where you get your head out of the weeds for a moment and you all of a sudden realize, well, what if I tried this? Or what if I had this partnership? Or I just made this relationship that opens this door for me? And it creates a step function in your success. But the problem is you'd never get that step function if you hadn't have pulled your head out of the weeds and done the meta work. So you've got to, just like exercise, you've got to have time on your weekly calendar that says, this is going to be unstructured, meta, high level thinking time. And apparently from, Tim's legion of experts, that's just a massive catalyst. And when I do it, and I'm not great about doing it, but when I do it, I invariably learn that lesson. And then, of course, the business drive me back down.
Well, I know, but that's the thing. That's the lesson I had to learn, is that what I would do with my workout is I'd just try to fit it in, wherever I could try to fit it in, right? And what would happen is that my calendar would book up with meetings, appointments, whatever, and it, before you know it, the day's gone and there's no time to get the workout in. And so I schedule a meeting every day. So I get up in the morning at 4, I do the radio show, then I do a couple of meetings, and every morning at 9 o'clock, I've got a blocked out meeting appointment on my calendar 7 days a week. That's my workout time. And that's my meta time. And I go out and I'm running or I'm in the gym lifting weights, but that I turn my phone off, I listen to some good music, and I just kind of, think about the things I need to do. And, but by having it on the schedule, A, people don't book on top of it, right? And B, I'm committed to go to that. And if you can't do that yourself, like a lot of people, they'll set a meeting for themselves, but then they'll talk themselves out of it. Get yourself a workout partner, and you got to get somebody that's really good, that's going to be there every day. I've had workout partners like, I can't make it today, whatever. It's got to be somebody that is willing to hold you accountable to that time. There's a really great group here in Houston called F3. And, it's a faith-based organization of guys, and most of them are, ex-military, et cetera. But they're a really great group of people, and they show up on time, they're committed. And if you can't block that time out on your calendar, get yourself a group like that where you're responsible to them to show up. And then that way, when you go, I'm tired today, but I got to go do this. And it'll keep you committed to that. And by doing that, A, you take care of your health, which is going to save you about $350,000 in retirement. And then the second thing is that you are going to feel better, and, getting away from work, when you come back to look at it, you see things very differently.
Hey, really well. So great point. This is a topic maybe for one of our next videos. The whole point about the community that keeps you accountable. Yeah. As you know, I used to do a lot of CrossFit. That I think was the secret sauce of why CrossFit exploded like it did. But whether it's exercise, whether it's advancing at work, whether it's dieting, I mean, just anything where you have a goal, basically, the research has showed very clearly that the number one accelerator to success is a supportive community that holds you accountable. So no matter what you're doing, you said earlier, with your top 3 list there earlier was, one of them was like create a great team of advisors, basically. Make sure you've got advisors that are holding you accountable to your goal, whether it's a board of advisors or whatever, board of directors or whatever, but just people that are incented in your success, but are there to basically kick your butt, if you're not meeting your obligations. Right. It's such an incredible catalyst towards success. All right. Well, look, I got to land the plane here because I'm almost in danger of making a liar out of myself. We're going to end this just about around an hour 40. Longer than I wanted it to be, but not quite as egregious as last week. So it's progress, folks. All right. Well, look, as we begin wrapping up here, I mentioned the Mark Faber interview a little bit earlier. If you haven't watched that yet, folks, it's a great one. Go to just wealthion.com, watch them. Well, I'll put up a link to it right here. So anyone interested, that'd be a great one to watch after this video. As I said earlier, I'm just going to remind everybody, given everything that Lance and I have talked about, this is an environment in which you are much better served, or almost everybody is much better served working under the guidance or with the guidance of a professional financial advisor that understands all the macro issues that Lance and I have talked about here. You should definitely be working with one. If you've got a great one, great, stick with them. But if you don't, or you want a second opinion by one who does, maybe even Lance and his firm themselves, just go to wealthion.com, fill out the short form there, and we'll set you up with a free consultation. Doesn't cost you anything, no commitment to work with these guys. They just do it as a public service. And last, if you enjoy these weekly market recaps, even a tiny iota as much as Lance and I do us a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Whatever happens from here, Lance and I will be doing our best to deconstruct it for you next week. Lance, thanks so much for your time again this week, buddy. Everybody else, thanks so much for watching.